Well, hello, this is Chris McAlpin with Sound Financial, and I hope you're doing well. You know, it seems that 2021 has started off where 2020 left off with some extraordinary events that we never thought we'd see before. And this week, I'm talking about GameStop stock. So I'm going to try to kind of explain this in a little bit of a light way. I'm even kind of grinning because I continue to chuckle about it a lot. Maybe you've been keeping up with this in the news, and maybe you're watching every move of this event. Maybe you even own some of the stock yourself, or maybe you're like a lot of people and you've turned the news off and you have no earthly idea what I'm talking about. I'm fixing to explain that a little bit. But a quick disclaimer, I do not personally own any GameStop stock, and nor is it intentionally in any of the Sound's models that we're holding. So we've received a lot of questions on this topic. So here we go. Let's answer a few of the questions around the GameStop stock event, okay? In general, what happened? Well, GameStop is a retail electronics and gaming store. Got a very loyal customer base, as you're going to see here in just a minute. But it's a old school brick and mortar retail store that sells games predominantly, and business-wise, it looks to be on its last leg. It's got a lot of debt. It can't make its payments, and this is what attracted all these hedge funds. They smelled blood in the water, and they started shorting the stock. And so as the whole plan, and I'm going to explain what a short is in just a second, but they wanted to profit as the GameStop stock fell. Well, a lot of the GameStop customers, they got together on a subreddit channel named Wall Street Bets. And this is a social media app that, unless you're in the know, you probably don't know much about it. They were infuriated at the idea of these hedge fund guys profiting as their company fell. And so they got together and they wanted to run the price up. It even kind of started off as a joke or a wonky idea to see how much money they could make by running this stock up. Everybody kind of piling in together and running it up. And just huge customer loyalty. And in 1 week, from about January 21st to about January 28th, they ran the stock up over 1,200%. And over the course of a year, it's in the stratosphere of returns. And so this wrecked the hedge funds, putting them into a short squeeze. And what's unique about this? So far, we're seeing one half of a pump and dump scheme. And we've never seen something so public take place, and we're getting to watch it as these events unfold. And so what do I mean by a pump and dump scheme? It's kind of an old school idea where people pump up the stock, run the price up real high, and then let it tank and short it on the way down, maybe buy it again, run it back up, and let it and short it on the way down. It's illegal. It's part of market manipulation. Now, these traders are doing this really to pump up the stock and protect a company that they love. I've had a lot of people ask me the question of, well, does GameStop, are they profiting from this where they now have the money to pay their debts off? No, not at all. GameStop's not getting any of this money per se, because unless they're selling stock on the open market themselves, which I doubt, because that'd be treasury stock. So a little bit of a modern day David and Goliath. And this is what I'd say for those traders, those guys and gals on Wall Street Bets. Number one, good for you. Congratulations. That's a heck of a job. I don't have any love lost for a lot of these Wall Street guys anyway, so I think it's kind of funny. But I gotta say, be careful, okay? Manage your risk. If you want to hang on to any of these profits, you better pay attention to what's going on with this stock, because the company was headed out of business, and at one point in time, it had a price tag last week of a $30 billion company. Those two don't go together, and eventually that stock is going to come down to reality. And so, on a little bit of a side note, Joe, I kind of wondered, had a client ask this week, what would happen if we all got together and we did this for good companies doing good work that, don't harm people and don't harm the environment, but enhance people and enhance the environment? I don't know. Maybe a podcast for the chase that we'll have to cover one day. So, what's a short? How does a short work? Why is it allowed? And so in short, no pun intended, when someone wants to short a stock, they're betting that the stock is going to go down. So for example, let's say that you want to short stock A and it's $10. You go to your broker, you put a short position in place, that broker loans you stock A, and you owe stock A back to the broker. So the broker loans you stock A at $10. When the stock A runs down, falls down to $6, you go to the open market, you buy stock A, you pay your broker back, and you profit $4 less any fees, premiums, and discounts that you've paid for the right to get to short the stock. In general, in a really easy explanation, that's how shorting works. Now, a short squeeze is when stock A is $10 and it runs up, let's say, for example, to $15, and your broker comes to you and says, you got a margin call, you owe us stock A back, you have to go buy stock A at $15, you lose $5, so 50%, less any fees and expenses, so even more, okay? That's in essence what the traders of the Wall Street Bets crew wanted to do to the hedge funds. They wanted to run them into a short squeeze, which is exactly what they succeeded at doing. And so why is this allowed? The general idea is that it creates an efficient market. It is allowed so that bad news about a company or the economy or the system in general quickly gets priced in, and stocks quickly come down to their inherent fair market value. Now, with modern day technology, it tends to overshoot on the downside just like it overshoots on the upside. So to wrap up, I've had a lot of people ask this question. How does this affect the market, and how might it affect me in general, me in specific, okay? First, the market. So we believe that the growth sectors of the U.S. market, especially technology, are overpriced. And they're due for a correction, which is a 10% loss or more. Now, the GameStop event could be a catalyst for this. Honestly, last week it looked like it was going to be a catalyst for this, but at the recording of this podcast or this vlog on Monday morning, stocks are up, so we don't know. All this to say it's hard, we cannot predict the future, but the data does say that the growth stocks, especially the tech sector, are overvalued due to pullback, and we're seeing a rotation from growth to value. And so that's where we want to be invested in higher quality stocks that are paying dividends, higher quality bonds, high yield bonds that are paying higher yields, and small caps in all of those areas tend to grow in the early stages of a growth economy, which it looks like the market's looking to in the future. So this event, it could trigger a short-term pullback, but time will tell. Overall, though, we're watching it just like everything else. We're watching it, 2021, we're just like we're in 2020, and it's going to make for a good story and make for a good movie one day. If you got any more questions, we're happy to discuss it. Appreciate the trust that you put into us. Thank you. Take care.